All right, let's get right into today's news update. So, a pretty bleak day for the UK economy and markets as well. Yesterday, we got some fairly awful data showing that GDP fell in June, and then this morning, had Q2 GDP figures showing that the UK economy has stagnated. And then to top it all off, we also got some pretty awful wage growth data that once again shows that UK workers are getting financially worse off. In this video, I'm going to go through all these new data releases and reports, and I'm going to explain why these figures are really worrying. I am also going to show you the latest analysis of when exactly the Bank of England expects inflation to fall. And I am going to explain why the odds of a September interest rate hike have just increased significantly. So if you want to know what's really going on with the UK economy, then carry on watching. So let's start with wage growth. In the 3 months leading up to July, regular pay in the UK grew by 4.8%, which was down from 5% in the 3 months leading up to June. And this was weaker than all forecasts. Economists expected pay to remain unchanged from the previous month, so this is bad news. Now, regular pay excludes bonuses and benefits in kind like cars. And if we look at total pay, which includes those additional benefits, then it tells a slightly better story. Total pay rose by 5.1% in the 3 months to July, up slightly from 5% in the 3 months to June. Again, this was also weaker than all forecasts, which expected total pay to remain unchanged from the previous month. So it's a bit of a mixed bag. Technically, pay is rising, but it's only rising at half the rate of inflation, which is currently running at 6.8. So in real terms, UK workers are actually getting poorer. There are always two types of inflation used when reporting on wage growth. You've got average earnings, which is adjusted for inflation using CPI, which is currently running at 6.8, as I mentioned earlier. And then you've got regular pay, which is adjusted for inflation using CPIH, which is currently running at 7.2. This takes into account the fact that when prices rise, people tend to switch to cheaper goods, which affects the basket of goods used to calculate inflation. And this change in spending habits affects the CPIH rate more than it affects the CPI rate. So using CPIH to adjust wages gives a more accurate representation of how much people's pay packets are really being squeezed. If we look at regular pay adjusted for CPIH, we can see that pay growth has fallen to 2.3%. Down from 2.6% in the 3 months leading up to June. This is the weakest growth since September 2023. And this is despite the fact that back in March, pay was growing at a whopping 7.2%. So you can see here that the situation is deteriorating and people are being squeezed harder. And it's not just wages either. Earlier this week, we also got data on the number of payroll employees in the UK. And this is a key metric because it strips out self-employed workers who saw their income fall by 4.3% in July. Compared to June, payroll employees saw their income fall by 0.3%. It's a small decline, but it's still the largest monthly fall since the start of the pandemic back in 2020. This is especially worrying when you consider that we're about to head into the busiest shopping time of the year. When you think about it, this is the worst possible time for shoppers and businesses alike. People are about to spend tons of money on Christmas presents, decorations, travel, and food, all while their pay packets are getting smaller. On top of all this, we also got data this morning that shows that the UK's job market is cooling. The number of people in work has remained unchanged since June, while the number of people out of work has ticked up, pushing up the unemployment rate to 4.7. which is the highest level it's been since early 2020. The big worry here is that if the economy keeps slowing down, businesses will need to cut costs to survive. And unfortunately, that often comes at the expense of their employees. And this is where things get really interesting. Earlier this week, we also got a report from the TUC, which showed that nearly 1 million workers have been forced to take on second jobs just to make ends meet. And almost a quarter of workers are planning to ask for a pay rise in the next 12 months. Now, if everyone starts asking for above-inflation pay rises at the same time, it's going to spark a wage price spiral that's going to push up inflation even further and force the Bank of England to hike rates further and for longer. On top of all this, we also got data this morning showing that the number of job vacancies has fallen by 10,000 over the quarter to August, which is another sign that the labor market is starting to cool. As I said at the start of the video, the picture that's emerging here is really worrying. Pay growth is the slowest it's been in over 3 years. Unemployment is ticking up and there are now 2.3 job seekers for every single available role. And on top of all this, we also got some really dire data yesterday showing that GDP fell in June and that the economy is stagnated in the second quarter. Now, on the surface, this might not sound that bad. After all, if the economy is stagnating, it's not technically in a recession, right? Well, not necessarily. But stagflation is usually associated with rising unemployment and rising inflation, which is exactly what we're seeing here. Now, if this sounds familiar, it's probably because we were in a similar position back in the 1970s when we experienced something called the Great Inflation. Back then, the UK government tried to solve this problem by hiking taxes, which pushed inflation even higher, which then caused even more wage rises, and it created a vicious cycle that took years to escape. Now, we're already seeing signs that this is happening all over again. Workers are getting fed up of being squeezed, and they're demanding above-inflation pay rises. Businesses are having to cut costs to survive, and that often comes at the expense of their staff. And as I mentioned earlier, the unemployment rate is also ticking up. So with all this in mind, what should you do? Well, first of all, you need to keep track of what's going on, which is why you should consider subscribing to the channel. We release daily videos breaking down the most important stories affecting your money, your investments, and your future. Now, secondly, if you're worried about losing your job, then you need to start cutting back on discretionary spending. Ask yourself if you can put any non-essential spending on a credit card and pay it off using the 0% on purchases offer that most cards offer. Most credit cards offer between 0 and 20 months to buy now and pay later without paying any interest. So if you can put your non-essential spending on a credit card and pay it off within 12 to 20 months, then it gives you a little bit more breathing room. And finally, if you're worried about your job security, then I'd highly recommend checking out Brilliant. Now, I don't normally promote other channels, but I'm doing so in this instance because I think it would be a really good move for anyone who is concerned about their job security. Right now, AI is transforming our world like never before. Companies are replacing staff with AI and it's never been more important to learn how to use AI to your advantage. If you want to understand how AI works, if you want to learn how to code, or if you want to upskill, then you need to check out Brilliant. Thanks for watching, and I'll see you in the next one.